Welcome to Accounting Made Simple. This week's episode, Adjusting Journal Entries. One of the main functions of the accounting information system is to record all of the money going into and out of the business. There are two ways to record this information: the cash basis of the accounting and the accrual basis of the accounting. Accrual basis records revenue when it is earned, records expenses when it is incurred. Adjusting journal entries are made in the journal to ensure that revenues and expenses are properly recorded under the accrual basis. There are 5 types of adjusting entries. In this episode, let's focus in on accrued revenues and deferred revenues. Let's look at scenario 1. Deferred revenue is earned when cash is received before revenue is earned. For example, Mr. Tyler pays Becky $1,200 once a year to babysit his child every Thursday night. At the time of the payment, Becky has not yet earned the revenue, so she records all $1,200 into a deferred revenue account using the following journal. She debits cash for $1,200 and credits unearned service revenue. So as you can see, Becky's cash account has increased, but her liability account has also increased as she now has an obligation every Thursday night to babysit Tyler's child. Now when a month passes and Becky prepares her financial statements, as of the 31st of January, she has now provided 1 month of babysitting and has therefore earned 1 month of revenue. So in order for the accounting system to reflect that she has earned this money, the following journal entry must be made. She must debit unearned service revenue, and she must credit service revenue for $100. In this entry, the service revenue account increases by the amount earned during the month and decreases the liability account unearned service revenue by the same amount. As a result, the equity account increases as the liability account decreases. Now let's have a look at accrued revenue in scenario 2. Let's say that instead of getting paid before she has provided the service, she gets paid at the end of every month, but Tyler does not pay her until the 15th of the next month. This means that under the accrual basis, she must record the revenue in which period it was earned. As a result, the following entry is made. She must debit accounts receivable for $100 and credit service revenue. This entry increases accounts receivable and service revenue by the same amount, $100 each. Then, when Tyler pays Becky back on the 15th of February, the following journal entry is made. She debits cash for $100 and credits accounts receivable for another $100. As a result of this entry, the cash account increases as the accounts receivable account decreases, meaning assets both decrease and increase by the same amount.